So the producer price index came out yesterday for the month of October. And as I predicted, we're seeing an upswing back up in commodity prices here. So back in September, we saw a monthly change of 1.1%, which was higher than an August change of 0.7. When the August report came out, some investors and economists were thinking that this could be a calming down in the producer prices. But with the shortages that have been taking place, the supply bottlenecks, the monetary stimulus, the government stimulus, the high amounts of government spending, even though those ended in the first two quarters, those are taking their effects now and are continuously putting pressure on rising prices. Commodities are usually the first place that those prices start to escalate from. We saw this back in 2010 and 11 when we were coming out of the last recession. And I still maintain that if it weren't for the fracking boom that started developing in 2012 and onward, we would have seen commodity prices continue to go up into another commodity bull market here. So final demand did tick upward, which is not a good sign for consumer prices because, as I've illustrated before, there's a strong correlation between final demand goods on the producer price index and the consumer price index, especially the consumer price index for the following month. So the fact that we got 0.6% this month is a good indicator that, roughly speaking, we're probably looking at around a 0.6% increase next month for the consumer price index report for November. Okay, so just keep on the lookout for that. I didn't think that we were going to see a tapering off just yet because on the government front, there hasn't really been a change in the inflationary forces, especially on the monetary front. Now, although fiscal spending has relatively tapered from the first two quarters, they are still at extremely elevated levels. And along with Federal Reserve asset purchases that are going on, along with low interest rates, it's just changing out some of that public debt for more private debt. Now, the advantage to the private debt is that you might get more of a private usage of those resources, but nevertheless, those resources are still being used up, which are still going to press up prices. Now, on an annualized front, the producer price index for all commodities has reached a new high of 22% annualized inflation rate. So this is higher than what we were seeing back in 2008. This is back higher than what we were seeing in 1980. We have to go all the way back to 1975 to see peaks like this. This is a really bad sign that we are going to see some real high inflation coming soon over the winter and the early spring before we finally start calming down, if we're going to calm down from this situation. And when I say we're going to calm down from inflation, it does not mean that inflation is going to stabilize at around 2% or lower for consumer prices. More than likely, it's going to stay elevated well above 2%. My guess is somewhere around 4 to 5, and that's going to have certain consequences that occur in our economy, which I will recap in another video. Now, for final demand goods have now reached a new high of 8.6% inflation. Again, this is higher than any time reported for final demand, even though we basically only have 11 years of final demand annualized prices to look at. Nevertheless, this is extremely concerning here that we're at this high inflation, because if we're at 8.6% final demand inflation, more than likely we're going to see that come up in the consumer price index. And when we take a look at the tables for producer prices, let's go into final demand. If we look at here, we realize that final demand, along with commodities, does not take into account housing. So it does not take into account shelter. And shelter has been the component that has been lagging behind in the consumer price index. So I would guess that if it weren't for that shelter component, the CPI would probably be closer to that final demand producer price index. And that's probably what's been throwing those numbers off, is why the government statistics on the shelter component of the CPI has been lagging so badly in the wake of higher rents and higher housing prices. that's definitely going to push up, and it will put the consumer price index report more in tandem with this final demand. So we can kind of look at this 8.6% for final demand as a forecast for what that consumer price inflation report will become, or could become, or get up to somewhere around that level, and that's very, very concerning. Now, when we take a look at what's going on, we see that the inflation really is hitting us in the goods sector, which is very ironic instead of the services. The goods sector inflation is more important because that's what you're buying in hard materials. It's what you're buying in hard things. Okay, services is what you're buying to get goods to you. So when you eat out at a restaurant, right, that's a service. When you buy goods at a grocery store, when you buy food at a grocery store, that's a good. So there's definitely a difference that we're seeing here that has been going on here that is really pressing up these goods prices. And the reason why is because in the overall commodity index, especially when we go to intermediate demand, we're seeing a high amount of inflation in the earliest phases of producing goods called unprocessed goods. And that's really not a good sign, because what's inflating here, look at this month over month change. It's 8.4% month over month. That's going to come down the supply chain, okay? Those unprocessed goods will then turn into processed goods sooner or later, and when it does, it's going to press up those processed goods inflation, and that's going to come down to each stage of intermediate demand before it comes down to final demand, before it hits the consumer price index. So we're seeing this squeeze occur, but the fact that it's occurring in the earliest stages is not a good sign, because that means we're still going to feel the effects in later stages, and is probably a signal that final demand is going to push up. The real driver of this has been fuel. Fuel prices have been escalating in October. Now, granted, fuel prices have sort of leveled off in November, so all things holding equal, we should be seeing a drop in the producer price index month over month rate from where it is, and that makes a lot of sense, because this 2% monthly change in the producer price index is certainly record levels that we have not seen since really May and June. Okay, so May and June is about 3 or 4 months ago, 4 or 5 months ago. We have not seen that those monthly rates, and even then they were peaking. Now we're seeing an upslope here, but what I think is going to happen in November is we'll probably see a little bit of a tapering off if fuel prices hold steady for the month of November. Now, the forces that are holding fuel prices steady right now, or even for a slight drop, I don't think is going to maintain, because as we really go into the harsh winter, and especially as we start consuming more energy to heat our homes, that's going to drive up fuel prices. You also have to remember, we're not flying a lot, okay? So the airline industry is not consuming a lot of fuel. When that airline industry starts traveling more, and that's going to happen sooner or later, that's going to demand fuel, and that's going to press the prices up even further at the pump, and also hit us in other areas as well, as far as energy costs to heat our homes, which should reflect in a higher producer price index for unprocessed fuel, and then for processed fuel. Now, processed fuel's also pressed up at 5.2%. You can see that especially hitting hard in the manufacturing industries. Manufacturing just got hit with a record amount of orders this past month, well, actually past couple of months, and while that's a good sign, it also means they're demanding resources right away, and that's probably contributing to some of that pressing up. Now, when we take a look at the my final demand model to forecast consumer prices, just to recap here, the consumer price index for October is going to come out today. I'm looking at the CPI to hover around 0.7%. Economic expectations are 0.6%. We'll see what's going on there. But next month, once again, we're looking at another 0.6%. The year-over-year CPI looking to be at 6%. With the follow-up rising to about 6.5%, give or take. And that's definitely the concerning sign here. I'm going to really take a look at what's going on in that shelter component, and if we're seeing the upticks continue there. I expect that we will, And that should start bringing the consumer price index more in line with final demand there, okay? Guys, that's what I have today for the producer price index. I'll produce a report, another report analysis either tonight or tomorrow going over the consumer price index. That's going to be key there to gauge things that are going on in our economy. Definitely to take a look at that and dig into that. So once again, I thank you for watching this video. If you like the content that I provide, click that like button, subscribe to my channel, click the notification bell so you're notified anytime I upload a new video. As always, I thank you for watching this video, and I'll talk to you next time.